In this lecture, ICT teaches us how to approach trading during the Asian session, which runs from 7 p.m. to 9 p.m. Let's break this down step by step. We begin with the 5 o'clock candle close, followed by the 6 o'clock candle. The difference between these two candles represents the new day opening gap. This gap is less than 20 handles, and since there is no medium or high impact news today, we're in a low news environment. It's also Friday, and we have a large weekly range in play. After marking this gap, our objective is to observe how the market creates motion around it. As the market moves, we notice the formation of a high, followed by another relative equal high. We mark these highs as they represent buy-side liquidity. Once the market opens and moves above these levels, we identify a minor buy-side liquidity pool above and a minor sell-side liquidity pool below. The price action we want to observe is for the price to move above the gap, then retrace below it. As it moves downward, we want to see short-term lows taken out, which does indeed happen. Now, with both short-term liquidity pools above and below the new week opening gap, this leaves us with a new range of initial buy-side and sell-side liquidity after the 6 o'clock candle. It's important to note that when the price trades in a tight range after the market opens, it often signals that the Asian session will be quiet, and we should avoid trading in such conditions. Outside of these initial liquidity pools, we should look to the left side of the chart to see if there is any additional liquidity. In this case, we find another buy-side liquidity level, which we also mark. As we approach 7 p.m., the official start of the Asian session, we place a vertical line on our chart. The market then moves above the new day opening gap, but it does not take out the low. Before crossing this level, the price exhibits significant energy, and at 7 o'clock, it touches the high of the new week opening gap. When this occurs, particularly after a displacement, it signals that the algorithm is giving us a clear indication. With the element of time now in play, the market should displace above the relative equal highs and aim to take out the buy-side liquidity. At this point, everything is in motion, and the price shows no intention of moving lower, signaling that we are now fully engaged in the Asian session. We notice a bullish fair value gap, and when ICT is looking for buys, he prefers that these gaps remain open and act as breakaway gaps. Following the retracement candle at 7 p.m., it takes just 9 minutes to take out the initial buy-side liquidity. After the price clears this level, ICT expects it to accelerate quickly, as if it's fueled by rocket fuel. If it lacks speed and magnitude, we could be dealing with what ICT calls turtle soup. After the gap up, the price retraces and trades back to the main candle, which presents an excellent entry opportunity, a great buy. However, ICT had already taken his entry before the initial buy side was taken out. He anticipated that the down close candle would act as an order block. Important point to remember that price first left volume imbalance, then retraced below. This made ICT enter just below the close, at 18,599.75, with a stop loss placed below the consequent encroachment of the breakaway gap. So far, the price has taken out minor buy-side and sell-side liquidity, leaving the initial buy-side and sell-side liquidity intact. The price then moves above the gap, displacing just before the Asian session starts. These are the elements that should align before making a move. From my experience, it's easier said than done, especially for anyone new to trading. Patience is crucial. Give yourself time to learn and wait, just as ICT does. To anticipate how far the price might go after taking out the buy-side liquidity, we can use the Fibonacci tool to measure potential targets. We can look at the -1 deviation as a potential major move or target the midpoint between -1 and -1.5 as well. This can also be done graphically on the chart. By marking these levels daily, you'll learn how to refine and adapt your trading model effectively. In Asian Session, ICT also mentioned how he teach in the core content mentorship that how can we trade by fading the bull flag, which is a very common pattern in retail community. People usually wait for the price to break out of the flag and make a new high, often aiming for a move similar in range to the last leg. Price clearly did not follow this pattern, and instead we had a bearish ICT entry after a market shift. We could have entered at the fair value gap, targeting the initial sell-side liquidity, the highs, or the new week opening gap. Now, if you're trading the London session, which starts at 2 a.m., it's important to mark the opening range between 12 and 12:30 a.m. For the Asian session, we focus on the new day opening gap. But for London, we look at the highest high and lowest low between 12 and 12:30. These levels serve as critical reference points for the session and extended it until 4 a.m. ICT recommended trading the London session from 2 to 4 a.m., sometimes extending to 5 a.m. for Forex, but I believe this can be applied to futures as well. Let's break down what happened here. From 12 to 1 a.m., price moved down, a bit of a fake out to throw retail traders offside. Then, as we entered the London session trading range, price took the sell-side liquidity and traded in a range for a bit. We then saw an energetic bullish candle here. The price retraced slightly, moved again, and left a volume imbalance. It retraced to the volume imbalance and went to the low of the 30-minute range. I see a few potential entries here. After the London session chop, there was significant sell-side liquidity. Price took out the sell-side, retraced to the fair value gap, with a volume imbalance within this order block, which is within this larger order block. And by the end of the session, at 4 a.m., price reached the upper side of the range. These initial buy-side and sell-side levels are crucial, and Algo refers back to them during the New York session as well. In the New York session, now, we'll mark horizontal lines at 7, 8, and 9 a.m. to track these key levels. Between 7 to 8, ICT mentioned a potential reversal, which aligned with my analysis. Price action triggered buy stops, created a higher high, then displaced, breaking below initial buy-side liquidity and reaching the initial sell-side liquidity. We could have taken possible institutional order flow drill entry here at 2 past 8 if we had missed the initial move. A second shorting opportunity presented itself. The third candle pierced below the previous low and then retraced back above the volume imbalance area. Taking a short position at this point would have resulted in a profit as price eventually reached the new week's opening gap low. If you secure a profitable trade before 9 a.m., consider it a successful session. However, if you cannot trade that, focus on the post-9 a.m. trading hours. The gap between the previous day's close and the new day's open becomes crucial during this period as we transition from electronic to regular trading hours. When we encounter a significant gap down, especially one around 100 points, ICT's insight about gaps becomes particularly relevant. According to ICT, in such scenarios, there's a 70% chance that at least half of the gap will be filled during the trading session. After the price took out the lows and displaced above, yet still left a portion of the gap unfilled, this unfilled area becomes particularly significant. According to ICT's principles, the remaining part of the gap represents an area lacking buy-side delivery, making it a potential draw for liquidity in the future. To complete the objective of reaching the draw on liquidity, the price action strategically engineered the liquidity. It did so by taking out the sell-side liquidity, displacing above, and then retracing to a fair value gap. This move allowed the market to fill the objective, reaching the remaining portion of the gap that was initially unfilled. I'm working on PDF notes for the ICT 2024 mentorship to make it easier for you to study and revise these valuable lessons. If you're interested, be sure to check the description below for more details. If you're enjoying these summaries or have any constructive criticism, please let me know in the comments section. Your feedback helps me improve and deliver better content for you. Thanks for watching.